What if I told you there are people earning 6 figures, 7 figures, even millions of dollars every year, and legally paying less tax than people earning a fraction of their income? This isn't about offshore accounts or secret loopholes. It's not about tax evasion. It's about a fundamental shift in how you view money, assets, and the government. You see, most people spend their entire lives focused on one single question: how much money can I make? But the truly wealthy investors, the ones who build generational legacies, they ask a different question: how much money can I keep? And that's where real estate changes everything. Most people believe real estate creates wealth because property values rise. And yes, appreciation is a huge part of it, but there's a real advantage hidden inside the tax code that most people never learn. It's called depreciation. Once you understand how it works, you'll never look at a property the same way again. Today, we're going to break down one of the most powerful wealth-building concepts in America. By the end of this video, you'll understand why successful investors buy real estate year after year. Let's dive in. Most people think taxes exist simply to collect money, but that's not actually how the system works. The tax code is designed to encourage certain behaviors that benefit society and the economy. Governments want more housing, they want more development, they want more jobs and more long-term investment. Because of that, the tax code provides massive incentives to those who provide these things. Real estate happens to be one of the single biggest beneficiaries of those incentives. Depreciation wasn't created by accident. Congress intentionally created rules that encourage people to build, own, and improve housing. In other words, the government wants investors providing high-quality housing. And because you're doing the government's job, you are rewarded. That understanding alone completely changes how you view every investment deal. Most people only see appreciation. They buy a property and hope it goes up. But real estate actually creates wealth in 4 separate ways. The truly wealthy understand how to stack these 4 engines together to accelerate their wealth. Number 1 is appreciation. This is the simplest one. The property becomes more valuable over time, especially in high-growth markets like in-town Atlanta and the Beltline corridor. Number 2 is cash flow. This is the monthly income you receive from your tenants. It's the mailbox money that covers your expenses and provides lifestyle freedom while the asset grows. Number 3 is mortgage paydown. This is one of my favorites because your tenants are literally helping you pay off your debt. Every month, they are buying a piece of the building for you. And number 4, tax benefits. This is the one almost nobody talks about, yet it may be one of the most powerful advantage available to any investor. When you combine all 4, you stop working for money and start owning assets that work for you. Let's make this incredibly simple with a real example. Imagine you buy a rental property for $1 million, $300,000 is attributed to the land, and $700,000 is for the building. The IRS says land doesn't wear out, but buildings do. For residential property, the IRS allows you to depreciate that building value over 27.5 years. That means you get roughly $25,000 of depreciation every single year. But here's the fascinating part. You didn't actually spend that $25,000. No check was written from your bank account. This is what we call a paper loss. You could have $20,000 in real cash profit in your pocket, but on your tax return, you show a $5,000 loss. You're making money and appearing to lose money at the same time. That's the secret. Over the years, I've worked with physicians, attorneys, and high-level executives. They earn excellent incomes, but they face a massive problem: significant tax burdens. Eventually, they start asking a different question. How do I create more tax-efficient income? That's when real estate enters the conversation because it generates income with tax advantages attached to it. It's a completely different game. Average people focus on income. Wealthy people focus on assets. Average people ask, how much can I earn? But wealthy people ask, how much can I keep? That mindset shift changes your entire financial future. Wealth is rarely built from spending income. It's built through ownership. Ownership of businesses, investments, and real estate. These are assets that continue working for you long after you've stopped working. Now, let's talk about an advanced strategy many investors discover called cost segregation. In simple terms, not every part of a building depreciates at the same pace. Some items wear out much faster. Flooring, appliances, landscaping, these all wear out faster than the building structure. A cost segregation study identifies these parts so you can accelerate your depreciation and get those tax savings into your pocket much sooner. The details can get complex, which is why you work closely with a qualified CPA. But the concept is simple. Accelerate your deductions, improve your cash flow, and increase your tax efficiency today. Here's another concept that surprises people. Most think wealth is created by selling assets, but wealthy investors think differently. If a property doubles in value, the average person thinks, sell it. The investor asks, can I refinance it? Refinancing allows you to access equity while maintaining ownership. That equity check is typically tax-free because it's a loan. The asset continues producing income and continues appreciating while you use that cash for the next deal. Then there's the 1031 exchange. This allows you to transition from one investment property to another while potentially deferring capital gains taxes. It's a way to grow your portfolio over decades without the government taking a cut. There are strict rules and timelines, so professional guidance is essential. But this explains why many investors never stop growing. They aren't constantly resetting, they are strategically repositioning their wealth. The biggest mistakes I see: waiting too long for the perfect deal, trying to time the market, buying based on emotion instead of numbers, and ignoring the long-term tax implications of every move you make. Real estate isn't a get-rich-quick strategy. It's a get-rich-eventually strategy. The investors who win are patient, consistent, and committed for the long term. They understand that time in the market beats timing the market every single time. If you're just starting, learn your local market first. In Atlanta, that means understanding the neighborhoods, the infrastructure, and the rental demand. Talk to professionals who live and breathe this market every day. Study the metrics, run the numbers carefully, and then take action. The perfect deal rarely exists, but the wealth created by taking action on a good deal is life-changing. Take the first step today. If you take one thing away today, let it be this: the wealthy think differently. They focus on ownership, cash flow, and assets. They focus on understanding the rules better than everyone else. Real estate isn't just about rent. It's about combining every advantage together and using the tax code exactly as it was designed. Learn the rules, own the assets, and build your wealth. Your future self will thank you. If you found this masterclass helpful, subscribe to the channel and leave a comment below. Let me know what investment topic you want me to break down next. I'm Bru Krebs, your in-town Atlanta real estate expert. I'll see you in the next video.